What's going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to do some stock analysis for Target stock. This company is down another 3% today after the stock is down over 26% so far this year. So I've been buying shares probably for about maybe 2 months or so. And today I've added a couple more shares. And let's hope that this is the bottom for the stock. But the main things that have been driving this stock down are, one, we had inflation. So that kind of caused a issue because there was too much inventory and not enough people were buying it. And the general retail sector has kind of suffered because of consumer spending and the inflationary environment. And then the other thing that brought this company down was the whole political issues they were having during this summer. So those are the two main drivers of why this stock is down. And we're now at a $55 billion market cap, when, keep in mind, 2 years ago, this stock was over double what it's at right now. If we look at their revenue, the revenue chart looks pretty good because they're growing at about 8% per year based on the last 5 years. And last year they did $109 billion of revenue. So that's more than double what their current or that's about double what their current market cap is. Then the net income chart is not as good. This is the only thing that scares me about this stock, is because the revenue has pretty much been flat for the last 20 years. And there's been a couple years when it's gone up. 2022 was a special year, but really they can't really break this $3 billion mark of net income. That would be the main thing I think that would hold back this stock from going on a huge run. Is I think net income is pretty much the main driver of a stock price. So that's something you got to watch out for. Let's hope that they can bring the net income back up. As for innovation, or as for price to earnings, let's look at price to earnings. This chart's kind of weird because from 2010 to 2020, the price to earnings pretty much was about a 10 to a 15. And then after 2019, the last 3 years has kind of changed because the price to earnings went from anywhere from a 15 all the way up to a 28. And so with right now it being at a 16 times this year's expected earnings, that is definitely on the cheaper side. That's why I feel like this is a good price to buy at. Now, the next thing is innovation. As for innovation, I gave this a yes just because I think Target's pretty much doing as much as they can as far as innovation goes. On their website here, they give a few examples of how they've integrated Disney stores. They've integrated Ulta into their stores. They have tested their first net zero energy store. They have different store designs coming out. So they also have mobile pickup. They have an app. I feel like that's as much as they can do. So that'll get a check. Strong market share. Now, this is I gave this a yes because they do have strong market share, but it's kind of hard to judge because, again, it depends on how you measure it. So in this example, we see they have 10% market share, right? Then we see other numbers like their online sales is 18%. There's numbers even higher than that. This is a 38%. So the bottom line is it depends, but it's still a strong number. Return on invested capital is strong. If we look at that chart, we're going to see an ROI of only 11% last year, which is pretty much their weakest year, but normally it's about 15 to 20%. So either way, that's good. Then we look at their equity, and I gave this a yes, even though it's definitely not the strongest trend here. In the last 3 years, the equity has gone from 11 billion to 11 billion. So kind of flat, but in the last 12 months, we've seen it go from 10.5 to now almost 12. So there is, even though it's not super consistent, there is some improvement there. The equity is definitely over 15% of the market cap because it's only a $55 billion company. The share count is looking pretty good, actually. This was better than I was expecting because it's only they're very consistent with decreasing their shares. They're buying back about 3 to 4% of their shares per year. So that's really good. The assets are definitely not 2x the liabilities, and the profit margin is not over 10%, which I think that's kind of typical for retailers. Cash and receivables is $4 billion, I believe. So that's more than their usual 2.5 or 3 billion. The dividend is healthy. We're looking at almost a 4% dividend, and they're growing their dividend. The payout ratio is under 60%. So that's all good. The company is definitely over 10 years old. And their free cash flow is also pretty good. If we look at the free cash flow chart, last year was negative, but I would say this chart is not super consistent either. It has lots of ups and downs, but generally I would say over the last 10 years, they've shown some improvement. So overall, that's why I'm a buyer of Target stock, even though some of their financial metrics are not perfect and they could be better, especially net income. I still think that they're going to continue to be a dominant retailer, and I don't think the stock deserves to be pushed down this much. So that's why I am a buyer of Target stock.